Hey soldiers, looks like we got ourselves an old-fashioned bank run. What's a bank run? Well, it's when depositors rush to get their money out of a bank because they're no longer confident in that bank. Now, can this happen to your bank? Well, it's happening to the second largest bank in Switzerland. Credit Suisse warns of a $1.6 billion loss after clients pull their money. Now, this is important because Credit Suisse, as I said, second largest bank in Switzerland. It's big, global name, and they made some bad bets, and here we are. Credit Suisse Group AG warned it would lose around $1.6 billion in the fourth quarter alone after customers pulled their investments and their deposits over concerns about the bank's financial health. That's why you always got to be, don't just take it for granted that, hey, I'm banking with the big boys. Always keep your eye on this stuff. Switzerland's number 2 bank by assets said outflows were around 6% of its total $1.47 trillion in assets, or around $88.3 billion between September 30th and November 11th. Now, for comparison's sake, JP Morgan has about $3.2 trillion under assets under management rather. So they are, Credit Suisse that is about half the size of JP Morgan. So no small sum, okay? Half of $3.2 billion is very, very significant. Customers in its wealth management arm, its main business, serving the world's rich. Now, these are the world's rich, okay? Removed $66.7 billion from the bank. Credit Suisse in late October said a social media frenzy around its health was causing large outflows. The fast pace of withdrawals meant the bank's liquidity fell below some local level requirements. The bank said it maintained its required group level liquidity and funding ratios at all times. Banks must keep enough liquid assets on hand to meet expected cash outflows in a 30-day period under post-financial crisis era rules. So this loss of confidence translated into a loss of real dollars. 67 billion real dollars was evaporated from the bank's assets, right along with customers' confidence. Of course, the company's stock fell 5% on yesterday. Well, yesterday for them. If sustained, the decline would take the price below its lowest level since September 29th. According to Fact Sheet, the shares are down nearly 60% this year. In another blow to them, the cost to insure the bank's debt against default rose on Wednesday. Now, they're over there trying to furiously reconstruct and reconfigure their operations. They received shareholder approval Wednesday on a plan to raise more than $4 billion in new stock. It is in the process of selling a large group within its investment bank to free up capital. This is all a part of their recovery effort. Now, again, why are we covering this? Because I want you to be well aware of what to look for when banks start to get into trouble. Now, one of the reasons why they got into this pickle is because with the downturn in the economy, folks started investing less. They started stacking up real hard assets and cash. And this bank relied heavily on wealthy people putting money to work in markets. And they would collect fees from that type of investing. Well, when people don't invest, of course, what happens? And then on the other side of things, the funds the things rather that you are invested in, if the market is tanking, well, you're taking a bath on that as well. So it was a kind of a cascade effect. Do I think this bank will survive? I do. But it's going to take, if the economy gets any worse than it already is, which I believe it will globally, then I think that it's going to hurt the bank even more. Via the FDIC, the Federal Deposit Insurance Company, it's basically the United States of America telling you that it's a bad idea to have more than $250,000 in one account. They don't want you to have too much money in the bank. Now, some of you might say, well, I don't have anywhere near that in the bank. Fine, I get it. But whatever you have in there, I'm sure you don't want to lose it. So that is why you should keep your finger on the pulse of what's going on at your bank. And quite frankly, I've talked about it, many, many times before. A bank, in my view, is for transactional purposes or loan purposes. So if I need a mortgage, okay, a bank is an option. Transacting and paying bills and doing that day-to-day stuff, okay, fine. A bank is necessary and very practical for those purposes. Taking it a step further, you may also want to look at a credit union to serve those same functions. But when it comes to putting money away and having it grow, a bank is not the place for that unless you have done your due diligence and you are investing, you are a shareholder in a bank. Then, okay, fine, that makes more sense. Or unless you own a bank in the form of insurance policies that you can borrow from yourself and have, typically, if they're structured properly, a permanent life insurance policy has a higher return than a bank account. Now, I will never suggest that you put all of your eggs in any one basket. Again, you have to have some sort of transactional ability to just get through your day. Okay, you can have millions of dollars in an insurance policy, fine, and it can be growing at a great clip, saving you all kinds of money, giving you tax advantages, but you can't whip out a card associated with that insurance policy and pay for a Whopper at Burger King. So you need the practicality to have your money accessible immediately so that you can transact. It's where a bank comes in. Or, again, if you invest with them, maybe you'll make a lot of money based on the bank you're invested in. But consider this, the banks are paying you whatever the interest rate is, 1.5% or what have you, and then they're going right to the customer of the bank. You're lending them money, in effect. Then they're going out and grabbing a customer for a credit card and charging them 16%. Look at that spread in there. That tells you, this banking model is lucrative. Might want to, do my due diligence and invest. But putting your money in a bank and thinking it's going to grow is a bad idea. Use the rule of 72, for example. This will tell you how hard your money's working for you. All you got to do is take the interest rate of whatever you're getting, let's say 1% in the case of a bank. Take 72 divided by that interest rate. 72 divided by 1 is 72. Add 72 years to however old you are right now. And at the end of that point, at the end of that 72 years, that's when your money would have doubled. And even though it did double, it's worth more now. But, well, actually, it's not worth more now. There's a higher denomination on money now. But because of inflation, in 72 years, $10 will probably spend like $3. Okay, or less. All right, guys, so just food for thought. Speaking of food, I hope you're going to enjoy your Thanksgiving, and I will talk to you soon.